So we just got our hands on this new report about consumer credit. And honestly, it's a real head-scratcher. It's basically telling two completely different stories at the exact same time. One story is all about stress, all about warning signs. But the other, it's surprisingly optimistic. So what on earth is actually going on?
That right there is the big question we're going to unpack. A brand new survey from the American Financial Services Association, and this covers everyone from mortgage lenders to credit card companies, lays out this massive contradiction. So let's dig in and figure out why they're so worried about right now, but so hopeful for what's just around the corner.
All right, first things first, let's talk about the here and now. We've got to understand what's happening in the current environment that's making lenders so nervous. This is the first half of our story, the present-day stress.
And this number is really where the story begins. It's called the Net Increasing Index, or NII. It basically measures how lenders are feeling about business, the difference between those who think things are getting better and those who think they're getting worse. And for the first time in over a year, after 4 straight positive quarters, it's just tipped into the negative. The optimism for now has officially run out.
So what does a negative score like that actually mean? In plain English, it's pretty simple. More lenders are saying things are getting worse than are saying things are getting better. You can see that a full 26.5% see conditions deteriorating, while only 21% see any improvement. That gap is exactly why we're seeing that negative score.
But look, this bad feeling isn't just some vague vibe they're getting. It's tied to 3 very specific, very real red flags that lenders are seeing right now. So let's break down the data behind each one of these.
First off, people just aren't applying for as many loans. More than a third of all lenders saw demand drop. But the really eye-popping number is in the subprime market. That's folks with lower credit scores. Demand there has absolutely plummeted, hitting a deeply negative score of negative 22.2. That is a huge warning sign for some of the most financially vulnerable people out there.
And the second big problem? Loan performance. This score, negative 8.8, tells us that more people are struggling to pay back the loans they already have. This number actually flipped from being positive in earlier surveys, which means things like defaults and late payments are on the rise. This is the real-world pain that lenders are feeling right at this moment.
So, yeah, the present looks a little grim, but this is where the report gets really, really interesting. Because despite all those warning signs we just talked about, lenders are incredibly optimistic about the next 6 months. Let's find out why.
Just look at this. This chart puts that contradiction front and center. Current conditions are down here at negative 5.9, right? But their expectation for the near future is way up here at a booming positive 20.6. That's the most optimistic they've been in a whole year. So what gives? What do they see coming?
Well, it pretty much all boils down to this one powerful chain reaction that lenders are banking on. It all starts with the Federal Reserve. Lenders are convinced the Fed is going to keep cutting interest rates. When that happens, it gets cheaper for them to borrow money. And in turn, they believe that's going to fire up demand for loans all over again.
And here's the proof that part of this chain reaction is already happening. This number, plus 42.2, is the score for their current funding costs. Now, a positive number here is great news for them, and this is the 5th quarter in a row that it's gotten better. So their cost of doing business is already getting cheaper.
And they don't think this trend is stopping anytime soon. In fact, lenders are forecasting that their funding costs are going to get even better and dramatically so over the next 6 months. This powerful belief that money is about to get a whole lot cheaper is the main fuel for all that optimism we're seeing.
So, lower rates, cheaper funding, more loans. It all sounds like a pretty smooth ride from here on out, right? Well, not exactly. Because hidden inside this sunny forecast is a completely different and frankly much more troubling story for one specific group of people.
The real story, the most crucial piece of this entire report, isn't about how many loans are being given out. It's about who is expected to be able to actually pay their bills in this new environment that's coming. And here it is. This is probably the most shocking number in the entire report. While lenders think overall loan performance will stay a little bit negative, look at their forecast for subprime loans. It's a staggering negative 44.4. That is not a gap. That's a chasm. It suggests that even if the bigger economy gets better, the most vulnerable borrowers could be headed straight for a cliff.
And just so we're all on the same page, when we talk about subprime borrowers, we're talking about people who are seen as a higher credit risk. This is often because of a rocky credit history or having a lower income. These are the consumers who are the most exposed when the economy gets shaky.
So let's connect the dots. We've got present-day pain, future optimism, and this terrifying forecast for the most vulnerable. What's the big takeaway from all of this data?
What's the real story?
The head of the very organization that put out this report, Celia Winslow, she says it perfectly. This isn't one single story about the economy. The data is clearly showing two different futures, one that's improving for many, and another that's going to be particularly challenging for lower income and higher credit risk Americans.
So, if we boil it all down, it looks like this. Lenders are willing to look past the current pain because they're betting big that the Fed is going to cut rates. But their very own data shows this huge risk for subprime borrowers, which really suggests that any recovery we see might not lift all boats equally. This is exactly what economists call a K-shaped recovery, where some parts of the economy shoot up while others fall sharply down.
And that leaves us with the most important question of all. This report gives us a forecast based on numbers and charts, but the real-world impact is about people. As these economic winds begin to shift, the data is basically screaming at us to ask, who gets to ride the wave up and who gets left behind?